Now we turn our attention to bonds, which if you're a young viewer, college age, won't be all that exciting to you or really all that important at this stage in your life. But as you get older, bonds will become increasingly a valuable part of your investing strategy. But since I know they're not terribly exciting and it may be a while before you use them, I won't spend too much time on it. And if you're older, don't worry, you're not missing anything. Bonds are really quite simple, so you don't have to understand them in any great detail to utilize them in your investing strategies. So just to make sure we understand where bonds come from, when firms or any type of organization needs to raise money, bonds are always an option. For for-profit organizations, for businesses, they have two options. They can issue stock, which is also known as equity financing. And if they do that, they're effectively selling off pieces of themselves, okay? Or alternatively, they can issue bonds, also known as debt financing, where the firm is, instead of selling off pieces of themselves, they're simply just borrowing money. So they've got two different options. Now, if you think about it, one of these is going to be very different from the other. These are very dissimilar things. If you're investing and you're thinking, well, I'd like to invest and have the chance of, 10xing my money, that's not going to happen with typical bond investing. Bonds are more stable and the payouts are more certain, okay? So for example, you might borrow as a firm $1,000 with promise to repay $1,100 in 2 years, and that would be indicative of a bond with an interest rate of about 5%. Now in reality, firms aren't going to just issue one bond like this. They might issue thousands or millions of bonds like this. So if you're a big firm like Microsoft, for example, you've done both. You've issued stocks to raise capital and now you're publicly traded, but also you've issued plenty of bonds and those are also publicly traded. So when it comes to stock ownership or bond ownership, a lot of the action is in the secondary market. The primary market for bonds, like the primary market for stocks, connects the buyer with the seller, and in the case of bonds, that's the borrower and the investor or saver, whatever you want to call them, are directly connected. So if you buy Microsoft bonds on the primary market, you're actually lending Microsoft money. But in most cases, as individual investors, that's not where we're buying our bonds. Unless we're investing with the US government, most of our bond transactions happen on the secondary market. And when you trade on the secondary market, you're just buying from another investor. And when you buy from another investor, you're not directly connected to that company. So if I buy state of Alabama bonds, there's a good chance I'm doing so on the secondary market because those are usually the easier channels for individual investors to purchase. And a lot of the transactions that people make in the stock market and the bond market don't happen with individual firms. Just like we talked about mutual funds and index funds, there are corollaries to that in the bond market. So in this brief chapter in the book at freefinancebook.com, I spent some time talking about bond index funds, which are passively traded funds that contain a bunch of different bonds all within one asset, all bundled together. So just like I don't really want to be in the game of buying individual stocks for the most part, I'd rather buy a collection to kind of diversify my risk. The same goes with bond ownership. I don't generally try to buy individual bonds. I don't really see much practical advantage in doing so in most cases. Instead, if I want to invest in bonds, I'm just going to buy a big chunk of them in an index fund, just like I would with stocks. Now, when people think of bond investing, they generally think of bonds as being stable assets that are low risk. And I can understand why that would be the case, but they don't have to be low risk. Bonds can be incredibly risky. In fact, a lot of them are. If you loan money to a small startup company or a country that is currently in a lot of turmoil, those types of bonds are incredibly risky. And as you might expect, they yield the possibility of high returns because to accept high levels of risk, investors must be compensated with high levels of return. So it is possible to go out there and find bonds that offer potentially really high returns. But for individual investors, again, most of the time when we use bonds, it's for the traditional way of reducing risk, giving us nice, stable returns. Nonetheless, all bonds have risk, okay? And the most obvious form of risk that bonds have is default risk. Some bonds have very high default risk. You know, if somebody comes up to me on the street and asks for money and I say, here you go, here's 20 bucks, and they say, we'll pay you back tomorrow, that's kind of like a bond, and it's a really risky one. It's very unlikely that they're going to pay me. And there's a spectrum. Some bonds are very safe, some bonds are very risky, and a lot of bonds fall in between. Default risk effectively just means how likely is it that the borrower never pays you back. Some bonds are very low risk in this regard. Famously, U.S. governmental bonds are often considered the lowest risk bonds that you can invest in. But there are other very low risk bonds that are out there. I mentioned Microsoft. Big companies like that also generally are considered very low risk borrowers. And other countries, other wealthy, well-developed countries, loaning money to those countries via bonds is usually extremely safe. The U.S. government has never defaulted on any bonds that it's ever issued, so we'd consider it as safe as it could possibly be. But there's still always some risk, right? There's some risk that something could happen and they wouldn't pay you back. And then, of course, there's higher risk bonds. Small firms, municipalities, individual towns, especially towns that already have a lot of financial trouble, those could be riskier. And so, there's, a spectrum there in regards to risk. But as an individual investor, again, I don't really so much care about that. Most of the bond investing that I would do would be for stability. And it's not that I don't care about return, it's just if I want high returns, I've already got stocks. I've already got that avenue for investing. And so if I need some safety, investing in bonds provides that extra benefit, that value that I can't get from stocks. Now, if you're extremely wealthy or if you're running some sort of investment company, trading in bonds that are risky could provide potential benefits and greater returns. But for a retail investor like you or I, it's most likely, again, that we'll be using bonds for stability and still generating some return. In addition to default risk, a more obscure form of risk that exists is interest rate risk. So for example, imagine that I buy a bond for $10,000 that pays $12,000 in 2 years. That bond's returning about 10% annually to me. Okay, so when I bought that bond, the market dictated what sort of interest rate I could return on this. And so there's all kinds of different bonds out there, and you really don't need to understand them in great detail. But the way a lot of bonds works is this part is set. The $12,000, what it's going to pay in the future, that's the set part. And this price today, that's the part that's influenced by market dynamics. Okay, so this firm or municipality, whoever it is that borrowed money from me, they're going to pay me $12,000 in 2 years. But this price of $10,000, this is fluctuating. So let's say that right after I buy that bond, whether it be on the primary or secondary market is irrelevant. Right after I buy that bond, let's say that interest rates go up substantially. Is this good news or bad news for me and my bond that I already own? All right, that $12,000, that's set. That's not going to change. But what can change is the value of my bond today. And if interest rates on all bonds throughout society are going up, that means that my bond here now doesn't look so good. My bond is offering about a 10% return at present. That 10% return is not competitive in the market anymore. So the price that I can sell my bond for is going to go down, I don't know, maybe to $9,500. Just making up a number there. So interest rate risk is the inherent unpredictability and variability that comes with current bond prices. Now, if I'm an investor that's just going to hold this bond until it expires in the future and I get that $12,000 at maturity, maybe I don't so much care about that volatility, but in reality, there's always the possibility that you're going to sell your bond. And most bonds get sold many times over before they actually mature. So bond variability, this interest rate flexibility that we have, is an inherent side of risk. And this explains how you can lose money in the bond market, okay? If I buy a bunch of bonds like this, and then I sell them after interest rates go up, I'm going to lose money, all right? Even though the terms of my bond itself didn't change, market dynamics caused me to lose money. Of course, it could also go the other way. If interest rates go down, my bond will gain value. So risk doesn't always hurt you, right? Risk, you can be on the positive end of risk. But nonetheless, this just goes to show that investing in bonds does not provide complete stability, or it's not completely devoid of risk. You're still intrinsically connected to a risky asset. Very similar to that is the idea of inflation rate risk. So to give you the same type of example here, let's say that I buy a bond for $2,400, and that bond is going to pay me $3,000 in 18 months. Let's just say I buy this bond on the secondary market, right? This is how much it's going to pay me in the future. That right there is set. It's not going to change. This $2,400 though could. Let's say right after I buy this bond, inflation goes up. Would that be good or bad for me? That would be bad, okay? The reason it would be bad is because that $3,000 I'm going to get paid in the future is now worth less to me. And we haven't even defined inflation here, but I'm assuming you have a little bit of understanding, right? Inflation is just increasing prices. So if prices go way up right after I buy my bond, that doesn't change what I paid for the bond, but it changes the value of what I'm receiving in the future. So most likely, if I try to sell this bond today, it's going to sell for less than $2,400 because of inflation. But even if it doesn't, still the value of my asset is eroded, right? Even if we ignore what I could sell my bond for, that bond is now worth less than what it would have been if inflation hadn't gone up. So at this point, I'm kicking myself because I could have invested in some other asset like housing, which would go up with prices, or I could have bought stocks, which theoretically also prices would go up in the stock market. In this case, my $3,000 is fixed, so when inflation goes up, my fixed value now is worth less than it was before. So in all three cases, what you see is bonds provide variability, they provide risk, and there's no way to completely guide against that. Now, which is safer, stocks or bonds? For the most part, when we're thinking about the type of bonds that individual investors invest in, bonds are safer. But that comes at the cost of lower returns. Historical returns in the bond market really depends on the time period. They don't have the same sort of long-run predictability that stocks have because interest rates are governed by macroeconomic trends and things like the Federal Reserve. The Federal Reserve is the central bank of the United States. They drive interest rates in the economy. So this is not as freely determined in the market as such as stocks are. So the historical return for bonds is around 5%, but that is not, I don't think, a very good indication of what might happen in the future. This is very time specific. But nonetheless, you can generally expect more stability in investing in bonds, which means that they do play a good role in your portfolio. So in the following chapter, chapter 9, we're going to look at building a portfolio and mixing in stocks and bonds. But just to give you a general idea now, where bonds come into play is, again, when you get older. When you are, 20 years old, there's a pretty good argument for just investing all of your money in stocks. You might want to have a little bit in bonds, but really you could make a compelling argument that bonds are irrelevant when you're 20 years old. The reason is your time horizon is so long. If you're putting money in, a 401k when you're 20 years old, it's likely going to be upwards of 50 years before you touch that money. So you can handle the wild swings in the stock market. But as you get older, that gets tougher. When you're 60 years old, it no longer makes sense to have 100% in stocks for most investors. That's too risky. When you're 60 years old, retirement is in the near future, and you really could be financially ruined by a collapse of the stock market. So you need more stability. And so there's no exact number of what you would want to do here, but you might say at age 60, go 50% stocks and 50% bonds. And in doing so, you guide against or control against some of the risk in the stock market. Stocks and bonds are both risky, but what's nice about the relationship between these two bonds between these two assets, is when there is a recession, there is a negative correlation between these two assets. And that is that during a recession, stocks go down, but bonds actually go up. That inverse relationship between stocks and bonds doesn't always persist. During times of economic expansion, there's not necessarily these opposite movements. But when you're most concerned about the performance of your stock market, namely when there's a recession, that is when your account tends to be buoyed by your bonds. So having more bonds in your portfolio becomes more useful as you get older because risk starts to become more paramount in your decision making, right? If the stock market drops 20% today, I don't care. At my age, I'm 38 years old, I don't really care about that because I'm not about to sell a bunch of stocks. But if I was 68, that could be very damaging. We're going to talk a lot more about this in Chapter 9. freefinancebook.com, check it out. This is a really quick chapter. Chapter 9, we discuss stocks, bonds, target date funds, things that I think are really interesting and things that you can invest in now at any age.